And more earnings on our radar. We have L&T as well as Dr. Reddy's expected to come out with their December quarter numbers. Lastly, post giving a big thumbs up to Adani Enterprises, Cantor Fitzgerald now sees a demerger of Adani's airport business, but that after completion of the Navi Mumbai airport. Good afternoon, welcome. You're watching NDTV Profit. This is Market IQ and I'm Hersh Sayta. We're going to take a quick check of where markets are at. You're seeing the Nifty just below the 21,700 mark as we speak. It's a day of trade which is largely soft. It's largely range bound in trade today. And what we are seeing from a sectoral standpoint is banks, again, largely flat in line with where the Nifty 50 is. The Nifty Bank, therefore, largely flat as well. But you're seeing a bit of a downtick where Nifty Finance is concerned. So the larger financials are what is dragging the pack. Within Nifty Finance, you will see Bajaj Finance playing its role in dragging the Nifty Finance lower. But outside of that, it's a day of gains for the Nifty PSU Bank. Second consecutive solid day of gains. Nifty Media, Metals both gaining. Realty also up 1% thereabouts. Nifty IT up around 0.2%. So that's where we are at for those sectors where the Nifty Pharma, Nifty Energy are concerned. Nifty Energy saw a 5% uptick yesterday, but down. So a bit of a cool-off scene there. But Nifty Pharma, Nifty FMCG largely flat, around 1/10 to 1/5% of declines shown by both those indices. Where broader markets are concerned, especially where the mid-cap is concerned, you're seeing 0.2% of gains there. So you're seeing a little bit of consolidation happening as well as a bit of gains coming in over there on the Nifty mid-cap. Also, the Nifty small cap is up a solid 1% or 0.4% or thereabouts. So you're seeing good traction on the broader markets. If we can quickly have a look at the advanced decline ratio to kind of determine where the larger market is seeing gains and losses, and there you go, you're seeing a decent balance. The advances at 1200, the declines at around 750. So that's where we're at. But I want to pull out one stock in particular, Bajaj Finance. That one is languishing in trade today, and within the Nifty pack, that's the one which is really dragging top loser on the Nifty as we speak. And that's largely because of the mixed set of numbers that it declared for the December quarter. Now, where the good is concerned, you saw a solid growth both in NII as well as profit after tax. Profit after tax slightly lower than what analysts were penciling in, but the real growth came in on the AUM front. 35% growth on the AUM, which is quite solid. You also saw good client additions, but some of those numbers were already disclosed at the start of the month, and therefore the impact of that would have been factored. Now, what's really new this time around where the results have come? One is you've seen loan losses come in or rise by almost 20% plus in this quarter on a sequential basis. Now, when I compare Q1 with Q2 as well, we saw a good 20 to 25% rise at that point, and we've seen a further rise on Q2 of another 20 to 25%. Now, while loan losses are well within what the management has guided for, but this particular knock is what has impacted profit. So Bajaj Finance's numbers came in slightly muted, and what the management guided for, therefore, is that going forward as well, they do look to calibrate growth in the B2C segment, both in rural as well as urban. Now we had Bajaj Finserv, which is the holding company of Bajaj Finance. They also disclosed their numbers. If you can pull up that stock, and there you see it's largely languishing in line with where Bajaj Finance is, because Bajaj Finserv holds 50% plus of Bajaj Finance. But let's have a quick look at the numbers. The total income was up a healthy 33.5% odd, and you saw net profit also up roughly 22% thereabouts at 4,000 odd crore. So a decent set overall where Bajaj Finserv was concerned as well. So that's on the Bajaj twins, which are languishing in trade today. Largely the knock on Finserv, as I did mention, is because of Bajaj Finance. But let's quickly move on. We've spoken about the Bajaj twins. Those are the key ones. on the Nifty 50 that we had to address. Let's quickly go on to another one, KPIT Tech. That's trading at over 3% on the back of a positive set of Q3 numbers that have come through. We have Tushar who's standing by. Tushar, what are the key highlights of the quarter for the company? KPIT trades also at decently high valuations. So give us some insight on both of those factors.
So good afternoon, Harsh. So KPIT, again, sort of an outlier in the IT pack. Revenue was up 4.82% quarter on quarter. Margins were up about 60 basis points to about 16.59. Net profit is up nearly 11% at 156 crore. So what we have to remember that the company has, in a way, maintained its guidance at 37% for the full year ending March 31st, up from 30 to 32%. The EBITDA margin, as what the company declared, was at 20.6% in Q3. That is up again 60 basis points sequentially and in line with its expectations for the full year. So essentially, the company is very bullish on its growth prospects for a year in which most of the IT pack has declined. Other key highlights: revenue is up 4.3% in constant currency terms. EBITDA margin is 20.6% up. Deal wins stood at $189 million, which is with a healthy pipeline. So there is no pain there as what KPIT is seeing. About 600 freshers were hired. Again, very contrary to what the IT pack has done. There has been actually a net headcount decline at IT services companies. Overall, the headcount has risen to about 12,700 employees. Net cash balance is at about 829 crore, which is up 310 crore. We mentioned this because the company has declared an interim dividend of rupees 2.1. In terms of valuation, the company is still trading at about 75 to 80 times its price to earnings multiple. Still a pricey stock, though rest of the ER&D companies, where the space where KPIT functions, are catching up, specifically Tata Technologies, given its bumper listing that happened.
Right. Thanks so much for that, Tushar. All of that on KPIT. That one is buzzing on the back of numbers. But let's come back to Zee Sony. That's been a saga that's played out through January. And the saga continues. The NCLT has agreed to hear Madman Films' plea on the Zee matter in relation to the Sony merger. To tell us more about this, what's happening here, we have Charu joining in. Charu.
Hi, so as we all know that the termination of Zee Sony merger has been the talk of the town, and now Madman Film Ventures, which is a shareholder of Zee, has approached the NCLT to get the merger implemented, and NCLT has agreed to hear the plea, and the next date of hearing is set to be March 12th. Now, what has happened in the court is that Sony submitted before the bench that the approval from the NCLT that was received on August 23, 2023 is subject to certain conditions and can be waived off in writing or can be fulfilled also. So basically, it was not a hard and fast approval. It does not necessarily have to be fulfilled. To this, NCLT said that it's the correct or adjudicating authority and it has the right to hear the matter, and it will be hearing the matter. Apart from this, the contentions made by Madman Film Ventures, which is a shareholder of Zee, were that since the merger has already been implemented, it is only right that, since the merger has already been approved, it is only right that it is implemented now. Apart from this, Sony also said that Madman is nothing but a proxy on behalf of Zee in all this. However, NCLT refused to address all these contentions and has agreed to hear the plea on March 12, 2024.
Right. Thanks so much for that, Charu. We have the likes of Zee buzzing on the back of that as well. But I'm going to quickly move on. There's Orchid Pharma, which has hit 20% upper circuit after its new antibiotic drug got authorization from the European Medicines Agency. Now, Varsha is joining in with more on this. Varsha, talk to us about this approval as well as the impact of it.
Hi Harsh. So as you rightly said, European Medicine Agency has recommended granting marketing authorization for product called Exblifep. Now this is used to treat adult urinary tract infection and hospital-acquired pneumonia. Now overall effectiveness of this product, if you see, 79% versus 58% of the other product in the market. Now why this is important for Orchid Pharma is, now this novel antibiotic product is been made by Orchid Pharma, and they expect global commercialization in FY24. 2025. Also, company holds marketing rights in India and worldwide royalty sales right. Now, if you see this, they expect royalty revenue to directly flow into their bottom line. And Alkera Therapeutics, which company is into partnership with, has completed phase 3 trials in US and EU, and they are actually awaiting approval, which is expected in current year 2024.
Right. Thanks so much for that, Varsha. I'm going to move on. We have BSE Limited, which has been in focus all through last year. It's been a multi-bagger. And we had with us Sundararaman Ramamurthy, who's the MD and CEO at BSE. And he talks about how the change in people's outlook towards BSE and BSE's positioning in the Indian market is aiding BSE. He spoke with Sajit Mangas of our team, and listen into a slice of that conversation.
Cash market has been there for a long period, and there at some point of time BSE had a significant market share. Somewhere around Jan 2023 when we joined, we found that the market share has deteriorated a lot and come to single digit. It was hovering between 5 to 6% at that point of time. And in respect of derivatives, which is a 2 decades plus market in India, BSE had never had a steady volume or steady growth in the derivatives. It was
primarily led by LES, right? Liquidity enhancement schemes.
Correct. So it was only a liquidity enhancement scheme which was sustaining it to some levels, and once it was very clear if the LES is withdrawn, the structure may not stand the test of time. So that was the situation in respect of these two. In respect of currency, the futures were doing well and the options were not. Mutual funds, we were doing good. So this is what we inherited in Jan 2023. If you look at it, we try to make some product changes in the cash market. There you cannot create any unique position for yourself, which we can talk about later if you want. The most important area where we felt that we can position ourselves and we can make a change, we thought was derivatives, equity derivatives. So in equity derivatives, based on market feedback, we introduced, or rather reintroduced 2 contracts with slightly modified product specification. And that looks to be working well. That is one reason why the market has shown greater interest into BSE, and it's working. The most important point there is the way we are positioning ourselves is we are a complementary exchange and we are not competing with anybody.
Right, BSE Limited has had an outstanding run, and if we can have graphs, just the 6-month graph shows me 170% return from that sub 1000 level. Stock is currently sitting at 2200, and that's the 6-month chart. Just have a look at that. And when I'm looking at the 1-year charts, it's even more staggering. From a sub 500 level, the stock has gone all the way to 2180. So it's been a stellar rally for BSE. Keep your eye out on that one. A slew of brokerage notes also at the start of this month came out, and we've discussed this extensively. We had the management with us. You can, of course, watch the full interview on ndtvprofit.com. But let me quickly switch over. Bajaj Finance, again, I want to come back to that because we have a slice of what the management suggested on the con call yesterday. Listen into a slice of that, especially with regard to rural consumer lending as well as urban consumer lending, which is where the problem seems to be, where slippages and where asset quality is concerned. Listen in.
Clearly you see in rural B2C numbers slowly go down, which is not how you see in urban B2C. So we'd rather be data dependent than anything else. I think that's the only point I would make at this point in time. Does not mean we are not to remain watchful. Is an important point. But remain data dependent. At this point in time, it looks transient, is what I would say. Given what we saw on B2C, on the margin, we have cut even urban B2C. We've actually cut quarterly close to 450 to 500 crores of business because at some point India starts to be rural and urban as a mix. So we have in urban B2C on a preventive basis in the last 2 quarters more so have actually 3 quarters have taken action already and reflected in a 3% lower growth on a year-on-year basis. If you look at it, March quarter was 33%, is down to 29%.
Right. That was Rajiv Jain of Bajaj Finance, who's powered the company. In fact, there was also another clarification with regard to the leadership on the con call, where Rajiv suggested that he will still be an integral part of the leadership and they will be reporting to him, even though there's a bit of a rejig with regard to all his number twos. But that stock is languishing 5% lower in trade today. Just wanted to cap that off, and therefore we brought you that slice of that con call. But we'll slip into a very short break. More on the other side. We'll continue to focus on certain stocks and keep giving you IQ. Stay tuned to Market IQ. Welcome to Market IQ. You're watching NDTV Profit. I'm going to quickly go across to Marico, which reported an over 15% increase in its consolidated net profit, largely aided by packaged food. We spoke with the MD and CEO, Saugata Gupta, and he spoke about Q3 earnings, of course, outlining the key factor that will drive growth going forward. Listen in to a slice of that.
I think two things. First, obviously, you are right that it has been low single digits for the third consecutive quarter. Having said that, I think this quarter was slightly different in the sense that we took a significant stock reduction in GT so that they become viable for core growth. And therefore, I think if we had not taken that correction, that growth would have been 4%, which was slightly better than last quarter. Now, I think two things. If you look at the last couple of quarters, there was significant inflation, which led to consumers, especially in rural, either downtrading into smaller brands or titrating consumption. I think inflation is largely tapering off. We also seeing most of the players, including us, taking pricing corrections. I think the government continues to invest significantly in the rural segment. So we believe that going forward, especially from Q1 next financial year, rural volumes will definitely improve. We are seeing at least the first sign, especially in our core brand Parachute, where offtakes have started picking up, and then when the offtakes pick up, obviously it is followed by secondary and primary. As you know that because of the stress, a little bit of stress even in the trade, the STRs, the stock holding at retail also had gone down by 3 to 4 days. That has also led to some of the lower volume growth. But the offtake trends, for the first time, we are seeing reasonably encouraging offtake trends, which should translate into better volume growths as we move into the next quarters.
Right. So as price cuts anniversarize, as well as modest inflation in copra helps, which you just mentioned, could you give us some numbers on the volume growth in Q4 as well as going ahead in FY25 in the core categories, that is Parachute and Saffola?
I think the way to look at it is we expect the volume growths to definitely improve, and I think as we move, I think we will. You will see definitely from Q1 next year volume growths moving from the low single digits to slightly higher volume growths. It's very difficult right now to give an outlook. Having said that, I think we believe that at least in our core business next year, the volume growths will be definitely better. Saffola, as you know, suffered from a period of hyperinflation followed by hyperdeflation, and we also took some conscious calls to maintain threshold levels of margin. We expect Saffola also to move into mid-single digits volume growth next year. Also, the fact that there is no deflation, that will translate directly into revenue growth. The other area where we believe we will again accelerate growth this year. We had to do some consolidation in our food business to get our back end right, especially our supply chain, our cost structure, and also our stock freshness norms, which we are now back, and therefore food also is expected to grow 20% plus, and digital continues to grow. So I think overall there will be better volume growth next year. And also as far as bottom line is concerned, we would like to strive to deliver low to mid-teens bottom line growth next year.
Right, that was of course Saugata from Marico talking to us about Marico's numbers. But I'm going to switch focus, macros. We had ANZ research economist Dheeraj Nim, and he's pegged FY25's fiscal deficit target at 5.4% of GDP. And he also seems to suggest that the government will continue its spending momentum in FY25. Mind you, this week we have the budget as well. And what he seems to believe is that the government will continue to push expenses to avoid any negative fiscal impulse to growth. My colleague Mimansa Verma had a chat with him. Here's a slice of that conversation.
So it's a vote on account budget, which means that typically these budgets are designed to keep the fiscal wheels rolling until the new government comes in power and represents its budget in July, reflecting its own economic priorities, which means that we are not expecting a lot of tinkering around, the measures about revenue. For example, we don't expect a lot of tax rate changes, so to speak. But, the government will still be announcing a full spending budget, which will reflect, its economic priorities, its areas of growth that it wants to achieve, as well as its thinking on the fiscal glide path, which is, how much of fiscal consolidation in the fiscal deficit can be expected in this year. Now, for the FY24 revised estimates, that is the fiscal year ending March 2024, we expect the government to show that, they will be able to meet their fiscal deficit target of 5.9% of GDP, despite all the risks that we have noticed occurred through the course of the year. But for the FY25 is where we see scope for about a 50 to 60 bip consolidation in the fiscal deficit to 5.3, 5.4% of GDP, not more. So that is my key expectation from the budget.
Okay, so and how do you expect this FY25? How do you see the government is going to meet or fall short maybe of the fiscal deficit target for FY25? How is the fiscal math looking like there?
Right. So on the question of fiscal math, I think there is a need to take a step back and go to the 1st February 2023 budget, when the finance minister had announced that they plan to take a fiscal deficit target to 4.5% of GDP by FY26. Now, if it has to be linearly spread in 2 years, that means ideally the government should aim for a 70 basis point reduction in the fiscal deficit ratio in FY25. But I'm expecting about 50 to 60 basis points, which is somewhat less than optimal. The way I'm thinking about it is as follows. I think the government spending, when you look at the combined spending of states and center in GDP, has become very important. It's risen by about 5 percentage points in the last 3 years and is perhaps at a historical high since the turn of the century. And it's not happenstance. I mean, you have to understand that government spending has become the driver of growth. There is a very significant push in terms of capex as well as developmental spending, which is, benefiting the economy in very visible ways. I mean, India is one of the economies which has emerged from the pandemic with a higher investment rate and has a very solid growth fundamental. So I expect this to continue. I don't see any reason for the government to sharply scale down its spending in FY25, because that would be akin to taking the wind out from beneath the wings, right? Now, where would the capacity then come from to reduce the fiscal deficit? And I think that's where the government should really double down on its efforts of raising revenues. We've seen in the last 3 years that tax collections have been quite buoyant, and more particularly so for the direct taxes, such as income taxes from corporate taxes, personal income taxes, and so on. And I think that's where something positive might be brewing. So I think that, they should aim for better revenue mobilization in FY25, which should create the fiscal capacity to reduce the fiscal deficit ratio without withdrawing the support from growth that it has given to the economy the last few years.
Right, the focus is going to be all on the fisc, because on policy it's going to be at least the sense is that there may not be as many changes because it's actually an interim budget. But the fisc will be in focus because that will actually roll forward for the full year. So that's going to be a key question. But that's all that we have on the show today. I just want to quickly mark out the Nifty because that's at the day's low at the moment. So keep your eye out. It's a tough day of trade, but that's all we have for you on Market IQ for now. Stay tuned to NDTV Profit. We have more on the other side.